Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. I'm going to talk about the consumer this time. Household income, household debt. The consumer is the ball game when you look at the stock market and how the U.S. economy is doing. It's 70%. There's a lot of emphasis on manufacturing, a lot of data tracking manufacturing. You create something and send it out the door. They track that. And, well, that's 10% of the economy. Government's about 18. The rest of it is consumer spending. So it's kind of important what goes on with them, even though it's commonly overlooked. Start with the numbers. We're starting to get numbers back from the various governmental agencies. Initial jobless claims came in with a fanfare. Oh, look at 191,000. Hasn't been that low in a long time. Well, I'll give you a 60% chance that's an accurate number. They're just getting back in the collecting data business. ISM was important. The survey is for manufacturing. It's a little below 50, which is neutral. Service, well, it's continuing to grow. The biggest part of the economy is continuing to grow. We're looking at a rate cut here 2 days, December 10th. Yeah, it's probably in the bag. We'll get a quarter-point rate cut, 25 basis points, which will put the cost of money in the threes. We're technically at 4 right now, so we'll be in the threes. Yay. That might bring mortgages into the very high fives. The mortgage market has been kind of, well, let's say less than enthusiastic about having cheaper money. They are in a unique position. Basically, they have to have a certain amount of yield in their mortgages to cover inflation, because when they give you a mortgage, they monetize that debt into a bond before the ink is dry. And it has to be attractive enough for the bondholders to want to buy it. At this point, it should be mortgages need to be in the 6s or the very high 5s, or nobody's going to be interested. We're kind of there. I don't think the Federal Reserve lowering the cost of money, the very short end of the curve, as we say, they can't go much further, or the market is not going to care, which is something they don't want. Anytime you hear the term, the credibility of the Fed, that's what they're talking about. The Fed wants to lower the short end when everybody else who's active in the market, buying and selling, well, they have certain requirements before they buy, not necessarily sell. The rest of the interest rates, they're adjusting and making the yield curve what it's supposed to look like. They're going to have to go down a little bit if the Fed cut. Well, the Fed will cut. And then after that, boy, I hope there aren't any more, because it's not going to help. The annual income number, this is important. The post-COVID growth and the crisis in the manufacturing and service market and finding employees and everybody's out of town is over. The growth has stopped. The growth has stabilized in income. People got more income, but they're not going to keep getting more income. It's mellowing down, stabilizing more along where inflation is. Colorado just so happens, and this particular chart is the darker the red, the better. Well, Alaska, Colorado, North Dakota, Massachusetts, the median income in those states is about, call it 84,000, a little more in Massachusetts. Everywhere else, the fainter the numbers get, the less income. New Mexico is way down there. Colorado's always had high income. It's a relative young person, service-oriented economy. And they make a lot of money here because the people that live here have a lifestyle issue. North Dakota, people get paid the same up there because you have to pay them to live and work in North Dakota. Same with Alaska. You know the rest. Colorado's right up there, and it has always been right up there. That's not going to change. That's just how the rest of the country pays their people. Not an affordability issue, it's a lifestyle issue. Latest out of Bank of America, clearly what we have here, the dark line, is rent. Rents have stabilized. They've stopped growing. Mortgages have kind of stabilized. They are continuing to grow, not that much, but they're going to remain expensive for a variety of reasons. Cost of building a new home? Well, it's $200 a foot. 3,000 square foot house? $600 grand. Well, that's what it costs new. I'll guarantee you that's what's going to cost used. That is not going to correct. And going from a 30-year mortgage to a 50-year mortgage is not going to change that very much. Never did like that idea. So what we're doing right now is we're going back to what can the household afford? And this is against disposable income. It's a good number. It hasn't been this good in 30 years, 40 years. The consumer is not burdened with debt. Consumer is not in a bubble that needs to be fixed. They're doing okay with what they're borrowing. So some of them can buy houses, some of them can't. There are some things you really can't do anything about. I'm tossing this in here because it's becoming a bigger issue. This is just auto insurance. Auto insurance, since basically COVID, has doubled. It's probably not going to double again. So is homeowners. So has liability. So is a lot of them. And they aren't coming down. That is an integral part of having a house and a little bit of property. But it's also driving people like General Motors and certainly Tesla, who offers car insurance in California, because they have to. GM and Ford are probably going to get in the auto insurance business because they're going to be responsible for fixing their own cars. More about that later. It's not a big issue right now. Some of these real estate markets, well, as we know, this is Punta Gorda and Austin and so forth. Those markets are correcting back to something resembling normal valuations, a lot of these places, because they got a little overboard. It's not like we're going to come back down to try and seek affordability. Well, they need affordability, but they were overpriced to begin with. And those markets are correcting. And unfortunately, cutting rates is direct contradiction to this. And we'll see who does what after a house sits on the market for 6 months in Central Florida. Maybe they have to keep cutting prices before they sell it or they just walk away from it. Very different issues. Homeownership, as we all know, we've talked in the past, was a great motive. Clinton administration, some others. Good motive. Get more people to own homes. Take it from 63%, which is its historical norm of home ownership. Wow, let's go to 70, 73, 75. Well, that worked for a little while. That's when we got no document loans and federal assistance in buying homes. So you know all of it because it all came apart in 2008. It's been adjusting. It's been coming down. Unfortunately, some people in the media have said, oh, well, home ownership rates are dropping, so there must be a problem. Well, no, there isn't a problem. What they're doing is adjusting to where they have historically been stable. There are a certain percentage of people who focus and want to own a home and the various responsibilities. And there's a certain group of people that don't. They're better off renting. And that's the way that housing market works the best. That's kind of the way it's set up. And it's heading back towards that. You look at the homeowner's side of things, this is 90-day delinquents on first mortgages. It's 0.5%. These people that own homes, unlike there's 2008 and 20, where the delinquencies go up through the roof. For the most part, you buy a house, you do everything you can to pay for it. That's what you want. Pay taxes, insure it, you know the rest. That's not a bad change in the economy. It's probably very productive. On the 10% of the economy side, manufacturing, well, we've had a big boom in building factories. Yay. Some of them are starting to come online. It'll be a little while longer. And then down here at the bottom, we've had these data centers, which is fine. And as we've previously discussed, a lot of those are just ways to get off the power grid, which are expensive, but they're also coming online. It's not like manufacturing is going to be the great new boom in the United States. It's not. That's never going to happen. Manufacturing production is doing pretty well. This is back to 2000. It's okay. It corrects when we have recessions. It's not like the service side that continues just to move along with small corrections in recessions. We're not going to be a manufacturing powerhouse. We are always going to look for the low-end manufacturing. It was China exclusively there for a while. Those days are over. But it's going to be somebody else or a variety of other people for that low-end stuff. That's not going to change. So don't look for big booms in manufacturing. I tried to really encourage this market to correct back where it was, because we're about 15% ahead of where earnings are. And it was headed in the right direction, but bam, great announcement, very confident that money is going to be cheaper. So the market goes back up. This is going to hang on. We might even have a Santa rally. I love those. And maybe the market will hold up before the end of the year. Okay, it's got to correct sometime. It can't keep going here thinking that cheaper money drives investment earnings, which is what especially the S&P 500 is based on. Now, this was an interesting revelation that came out of Crane, which is a big commercial money market company. Wow, money markets are at $8 trillion now. Well, I know they were looking for something meaningful there, and that's not just the $4 trillion in 2020 is now $8 trillion in 25. Well, is most of that the money that we put into the market for COVID? Well, yes. And it was always going to come here. Stimulus money, like the money in the COVID, gets in the hand of the consumer and stays there about 2 weeks. Then it goes to the next level, property owners, debt, car loans, that kind of stuff, for about 2 months. Then after that, it gets into the hands of institutions, banks, pension plans, individuals that are better at money than other people, and it comes here in the money markets. That ratio compared to what's in a money market versus the 60 or so trillion, that's the valuation of the S&P 500 in the equity markets, the ratio is the same. It's just how the money is distributed. This is not particularly, it's certainly not bad news, nor is it a revelation of good news. It's just there's a lot of money in cash. Simple as that. And based on a question, nice person asked me, well, gee, how much money comes here, private money, private sector money, for net purchases of U.S. stocks? Well, it's a lot. And it's going to continue to be a lot. There aren't a lot of opportunities elsewhere right now. The opportunities of people buying domestic U.S. stock market has a great deal to do with the dollar. When the dollar gets stronger, they buy less because it's harder for them to make a profit. It's very clear with interest rates coming down, the dollar is going to weaken. When the dollar weakens, other currencies do better against the dollar. Yeah, and they make money. Okay, we get that. Well, there's been a lot of money rolling this way, and there's going to be for a while. It's going to be very interest rate sensitive and how other currencies do. And frankly, the rest of the world is just short of doing okay. They're not bad, but they're not okay either. They're somewhere in between. Okay, that's enough for now. Send questions along to info@shjwealthadvisors.com. Happy to deal with them. And I hope everybody enjoys their holiday season. And I'll probably see you next year. Thanks for joining me.